Ladies and gentlemen, my name is Subrata Sarker. I'm a mechanical engineer working in manufacturing industry since last 22 years. Today I'm going to discuss a topic which is a little bit out of my professional expertise area, that is the financial market in India. But I think as we are all earning money, so we need to make sure that our money are invested in the right places to get the optimum return. So for that, we all need to have a little bit knowledge about the financial market in India at this moment. But the basic structure of the financial market, there are two regulatory bodies actually. One is the uh, it's basically totality is under government of India, that is under Ministry of Finance, but there are two. One is a SEBI, that is a Security Exchange Board of India, and another is the RBI, and under which like stock exchange like Bombay Stock Exchange, National Stock Exchange, etc. under SEBI, and below that like stock exchange, a broker means different banks, like for example Aditya Birla Capitals, and all these are comes from the category of broker, and then the individual agents and all this is the basically structures. And another instruments like which is very much popular today, that is the mutual fund instrument, that is regulated and controlled by the both authorities actually, the SEBI and the Reserve Bank of India. Now, in Indian financial market presently, you can categorize into three areas actually. One is the, there's a security market, one is the forex market, and another is the derivative markets. Now, in security market, it can be divided further into two areas. One is the capital market, and another is the money market. Now, further, this capital market can broadly or there are primary market and the secondary market. Now, there it can be broadly divided into two areas. So one is the equity market, another is the debt market. And today I'll basically discuss on equity market and debt market. And we all know this is a very basic simple cycle of investment and the return process. Like people are saving money, they invest it into the banks, and the banks and institutions, they invest into the industry, and then the capital formation happens, then this earning distributed among the investors. This is the simple cycle of earning money process actually. Now if we consider like which are the instruments or the areas that are taking the major parts in Indian capital market at this moment, you can see in this graph, there are if I ordered in ascending in a way that the money market has got the maximum capture, then the equity market, then third position is in forex market, and in fourth position is the equity market. And equity market, not in the position, is actually how much is capturing the market, actually market share you can say, then the government securities and the corporate bonds. Now there are some things like this called the asset classes. Now in asset class, if you have these classes of assets, and what is the actual statistics say how much you can get return from this, actually these are the statistics. Like from the equities, it's in that obviously from equity you can get the highest return actually, maybe in short of at least 15% on an average, and from gold it is 6 to 8%, and from property or real estate you will be getting normally 7 to 10%, but it still depends on a lot of other assumption and parameters. And bank deposits like fixed deposit, term deposit, and all these things, you will get 5 to 6%. And this important point is like average inflation rate in India is about 7%, and where if you are putting your money into the this conventional debt market, that is in fixed deposit and all this in the banks, then you will be getting at least around maximum 6%. So you will be losing money actually if you are investing, because inflation is 7% and you are getting return 6%. So if you want to increase your money, so there are other options you have to like venture actually, for example equity market and some other things actually. Now there are obviously disadvantages and advantages are there in the debt market and equity market. For example, if we consider about this, the capital actually, like your capital is very much protected if it is in the debt market, like fixed deposit and all these things. But in equity market, it can go up, it can go down, so that is a risk always there. So upside is possible in equity market, but at the same time downside is possible. But in debt market and fixed deposit market, there is no possibility of upside of your investment of the money. Now, in debt market has a lot of instruments. Like one is the bonds and debenture, another is the money market. And money market further has got a lot of other instruments like notes, treasury bills, and certificate bonds, etc., etc. Now, in summary, in debt market, whatever permutation and combination you put into your investment, you can get maximum 7% return, and specifically after deduction of taxes and all these things, post-tax return will be maximum 6%. As I said earlier, whereas inflation is 7%. So that is no, it's not the intelligent way of investing money into the debt market, actually, in my understanding. Now, uh, still, if so, then why there is the debt market is there? So much a big debt market. Now there are three reasons actually, because one is to ensure the sustainability of the or stability of the financial system, and enabling meaningful coverage of the real sector needs, and creating a new segment of investors. This is the things actually. Now, who regulates all this market actually, financial market in India? Now, financial market as a money market is totally regulated by one is the Reserve Bank of India and SEBI, that is Security Exchange Board of India, and secondary market is regulated by BSE and NSE, that is the Bombay Stock Exchange and National Stock Exchange. Now there are many stock exchanges in India. Bombay Stock Exchange number one, and then the National Stock Exchange, and there are 21 more stock exchanges. It is in most of the capitals of the states of India, like in Kolkata, in Ahmedabad, and every most of the capital actually has got. So altogether there are 23 stock exchanges in India at this moment. Now in Bombay Stock Exchange, the total market cap is at this moment is 1.54 trillion USD, and number of company listed in Bombay Stock Exchange is about 5,800 companies, and indexes are like there are a lot of indexes, BSE indexes, BSE 500, and etc. So, and the owner of BSE is the Bombay Stock Exchange Limited. In the same way, the National Stock Exchange, the market cap is total 1.41 trillion, and number of company listed is 1656 companies, and indexes are Nifty, Nifty 500, etc. Now, if we compare this Bombay Stock Exchange with the world other stock exchanges like UK Stock Exchange and all these Tokyo Stock Exchange, Singapore Stock Exchange. So in level wise or this total from commercial point of view, Bombay Stock Exchange comes in the 10th position in world at this moment. Now, in top countries with the market capital, if you consider, just need to understand this, the US is in the total market cap in 23 USD trillion in January 2017, if you consider, whereas in for this India comes in 9th position, that is 1.7 trillion USD, and Switzerland is also actually comes below India in terms of this market capital. And in whole world altogether, the total whole world market capital is amount is 66 trillion USD at this moment. Now, when we are going to invest money into different banks, mostly today people are using bank, post office is going to obsolete actually for the investment purpose. Now, for banks, we need to know the most leading bank or the most you can say the biggest bank in India is State Bank of India, and as HDFC come into the second, and LIC come into fourth, though it's not a bank, but as far as the total market cap is concerned, then ICICI Bank or Axis Bank. So we must know in which bank we are putting our money, because now when in financial sector, when you are playing in this equity other than the debt area, so the risk is always there, but risk has got two categories. One is the this systematic risk, or one is the unsystematic risk. Systematic risk or macro risk, like there is a risk in the interest, in the market condition, the inflation, where actually control is not there by the individual institutions and all these things. But in unsystematic area, which is basically in a smaller way, actually business or financial or operational condition of the different organization, etc. And in summary, actually, when you risk, you are increasing your risk in investment, so your return will also go up. For example, like liquid fund, there is no this risk, and your return is also very less. For the debt funds it is a little more, maybe 6%. And for the equity, if you go for the balance fund or index fund or the equity funds, you may go return you may get maybe 15%, 20%, even sometimes 25%. So if you take a little bit risk or counted risk with your very, there's a back-to-back follow-up, so that you can put your money into the right places to get the much better or optimum, investment. Now, there is one thing actually, instrument is now is very much popular, that is government is also supporting in India, that is the mutual fund. Now, what is mutual fund actually? Mutual fund is a trust or a pool of savings actually. It is getting together and by invested into a common named share actually. So it's basically common people investing small money is put together making a big fund, and this fund is invested into into the different companies, and then the return comes and the returns are distributed among the people. So this is basically a professionally managed fund which are going to invest into the share market actually, or different other instrument in the money market and many other places. It's unlike you are investing directly into the share market. Now, in mutual fund, there are three types of maturity normally. One is the open-ended fund, so you can anytime withdraw the money. That is a closed-ended fund, so maybe 3 years or 4 years. So you cannot withdraw the money in the next 3 years or 5 years. So and another is the investment has got different objectives actually, fund types. So if someone say there's what is the type of the fund you are going to invest in the mutual fund, like it may be equity fund, it may be a debt fund, it may be a balance fund, and it may be a liquid fund, or it may be a gilt fund. So we all need to know this very basic, because this investment areas today is very much popular, and people are involving and doing investment in all. Everyone is going into mutual fund. And also need to know very basic data actually from 2007 to 17. Now you can see from 72 billion USD to 300 billion USD market cap for the mutual fund today in India. So obviously it's going good result to the people actually. So you can say the statistics of some of the good mutual fund performed in last few years actually. In the mid cap sector, its return is given minimum 14% and maximum 26% actually. And some large cap fund also I can say here 15 to 26%. So for long term investment, mutual fund is one of the best instrument today. You can get the maximum return of your valuable money, at least above your inflation rate. That's very important actually. And people are there are people actually, professional people, you can see here every day from from Monday to Saturday, they're sitting in front of the computer from the 9 morning to the evening, maybe 5 actually, for doing this dealing, the financial dealing and all these things. And today the common people, we are getting everything, this in mobile phone. In mobile phone you'll be getting every, like in money control site or everywhere you can get all this information in the system actually. So this is actually going to be a common and important instrument for today people for investing money in a mutual fund. As you know, this is and for every areas that is improvement or latest development or technological areas there. So I'm going to share this in maybe in coming days, and it's already started in developed countries. There's a robo actually giving advice instead of the expert people or experienced people giving advice why to invest, why not to invest, which investment is going to mature it so that much. So these are also now going to computerized actually in many countries. So this is a typical actually example of the robo-advised calculator. And the typical, one of the suggestion actually for a 40 years old person working in a corporate sector, so what should be the investment portfolio category? So as per robo suggestion, it should invest for 80% in the stock market and the 18% in the debt market. Maybe you should keep at the maximum 2% for the cashes. So I think this information are useful and a little bit for your investment purposes, and you can share. And if you like this presentation, you can share this to your friends so that it can be helpful to the people to invest rightly. And before investing anything, I would suggest we should know ourselves about the subject and the areas and get the statistics for the performance, and we should go for the return actually. Thank you very much for watching.